The commercial acquisition model by Tilt Analytics is a real estate spreadsheet tool for real estate professionals acquiring existing commercial assets that are not ground up development. I think you'll see that the model has more and better output reporting than any other model out there, as well as more functionality. Let's first take a look at some of the output reports. First up, you see the table of contents lists all the sheets in the model, and I have options to toggle whether or not I wish to show the sheets or not. So a lot of them you may decide that, oh, well, it's not relevant for me, and you can just hide it. Similarly, you can select which sheets you want to print for your package to send out to potential investors or whomever. As well, these table of contents is entirely hyperlinked. So heading over to my deal summary, here I am. You see there's a good overall summary of the project. All the sheets in the model are already set up for printing. The model also understands that you have different audiences and that the potential investors are a bit more focused on certain things than, say, the bank is. So the investors often like to see, when do they put their money in? When do they get their preferred return, return of capital, distributions of profit out? What's their IRR? What's their multiple, profit, and payback period? And you see that I can see the numbers annually. And if I scroll over, I can see them quarterly and monthly as well. Analogous sheet for the GP. One of my favorite sheets in the model is the cash in, cash out. This is your entire project on one page. All the cash in to the project, all the cash going out of the project before payouts to equity, and then payouts to equity. And with all the sheets in the model that show annual summaries, I can scroll over to the right and I can see all the figures on a monthly basis. The banks tend to be a bit more on, say, cash flow from operations, where you have your revenues, your operating expenses, any debt service before tax, cash flow from operations, and then a variety of metrics at the bottom, such as debt service coverage ratio and so on, debt yield, operating expense ratio. There's other sheets that I won't linger on right now, but a couple of the obvious ones to look at would include a commercial P&L. We have a couple different versions of the commercial P&L. One of them with summary information up top for base revenue, losses due to rent roll vacancy. The model also factors in, for example, losses on double net or triple net reimbursements due to rent roll vacancy, further losses due to rent abatements or concessions, and then breaks out the operating expenses in each year with some per unit, per square foot, and percent revenue metrics. The other P&L is much more detailed, and so it gives you unit by unit potential revenue for each, the losses of potential rent revenue due to rent roll vacancy, and so on, all the way down. So anything about the operating performance of the building you want to see, it's all there unit by unit, and again, year by year and month by month. This commercial tenant Gantt chart is basically just a look at the status of each unit over time. So AT would be your active tenant. You got some downtime here. You got a period of month of free rent, and then your first tenant renewal or your first tenant replacement rather after the active tenant, and so on. There's also a number of what ifs to evaluate sensitivities on, for example, what if your exit valuation is different than what you think it's going to be? And it can show you a range of possible scenarios and the impact on various metrics here. So project IRR, LP IRR, LP multiple, and so on. We have variations on purchase price. What if your revenues are different than what you think? What if the interest rate on the acquisition loan is different than what you think? And so on. There's uses and sources charts. There's a nice breakdown here showing your commercial rents, however you'd like to see them. So I can see per square foot per year, and I can see potential rents, and so on. Or I could toggle and see, say, per unit per month, and this table updates and so on. So a nice, easy way to see what your projections are on a per unit basis. Summary of units showing active leases, status, and so on. Debt amortization table. A nice what if table here showing what if you sold the project in any given year in the model, and instead of the year that you entered in the model, and how does that affect LP returns and GP returns. There's a breakdown on the waterfall detail to help people understand how it gets calculated. On the charting side of things, there's some charting summaries. Also a nice chart for the LP cash. You see they put their money in, their outstanding balance. There must be a refi here, and then continued operations, and then the sale. A break-even chart showing money into the project and money coming out of the project. A look at the NOI, which factors in your tenant downtime and abatements and everything else. So some pretty good charting here. On the input sheet, and you'll notice that all the inputs are on one sheet, and all of the inputs are categorized across the top with headings, and all the headings are hyperlinked with your table of contents here in column D. And so as I scroll along, the table of contents remains there, and I can say, well, if I want to go and change my acquisition cost, I hit my hyperlink and I'm there, and I can change the purchase price. So with that kind of functionality, I can keep up with discussions with investors or real estate professionals on a Zoom call real time and change information as we go because I can navigate around so quickly. This model is built for the user to use the inputs on their own, but I'm also happy to assist if needed. If I'm doing a new project in the model, it's the only time I ever really scroll around in the model because I'll just start at the left and move to the right, filling in pertinent information. So if we have a sample project, Class A office, acquired, say, in June of 25 for $22 million, closing cost 2%. Here's my commercial units. I'm just going to say there's one of each and different square footage. I can tell the model the status of the unit at the acquisition, whether it's occupied or vacant. And then if it's vacant, the model actually asks you, well, why is it vacant? Is it vacant because it's empty space that's existing, or is it a future development? For now, I'm just going to put empty space for each of these. And it wants to know the status of the lease agreement details of all of your active tenants. So for all these that are occupied, I'm inputting whether they are triple net or double net or gross. When does the lease expire? What's the assumed downtime between tenants until your next tenant gets in there? If it's a renewal, you can just put 0. You can have then a couple different ways of inputting your TIs. You can indicate whether the acquisition loan is going to lend toward these TIs or not. And then you get into inputting for the assumptions on the renewal or the next tenant. So I'm just going to put a 5-year term for everybody. Everybody goes triple net. And then after that, the model will kind of roll over this as a hypothetical standard rinse and repeat client. So sometimes you get commercial space where tenants are in and out of there every 2 years or something, and you'll want the model to just auto repeat that if you hold the building for a long time. I can toggle unit by unit how I want to input my rent, so I can do per square foot per year, per square foot per month, etc., per unit per month. Here's my market leasing assumptions. So the model recognizes that your current rents in the building might not be market rent, so you can input what you think your market rent assumptions are in each year, and then you can reference that for your projections on rents later. So for example, if I'm looking at my commercial rents active tenant and I'm projecting their rent, I could say, look, this one's going to increase X percent every X years. So I'd say starting in January 26, it increases 3% a year every year. This next tenant might have irregular increases, meaning it was just agreed upon that arbitrary dates have arbitrary rent step up. So say August of 25, it goes to $23.10. February 26 goes to $23.50 and so on. And maybe my next tenant down, I use MLA. So that you're going to basically mark that to market for that tenant on the rent increases going forward. After that, I can just keep my life easy and say, yeah, just reference market rates from that point forward for any additional tenants. or you can input specific agreements, your choice. You also have the option for other revenues. So for example, if you had another revenue here, it might be that everybody in the building also pays a parking fee. And you could say, it could do per square foot per year. Say, no, I don't want to do that. I'm going to say dollars per unit per month. And maybe it's $50 a month. Broker leasing commissions, I can do those a couple of ways. Percent of the leases. So I can say, look, it's 6% of the lease for the first 5 years. You can also do a dollar per square foot method. In addition to TIs, I can have separate scheduled renovations of units if that's relevant. And I can have general property renovations that are not tied to any unit. So I can say, look, starting in August of 25, I'm going to spend 4 months doing a renovation. It's going to be a CapEx, so it's not going to be in the P&L, and the acquisition loan is not going to lend toward it because we're replacing the HVAC. It's going to cost approximately $1.3 million. On top of your projections for downtime between tenants, you could also add to it a sort of haircut assumptions on vacancy, concessions, and bad debt. Operating expenses, I can list them by name. I can input them with different methods. You see here I can do per unit, per square foot, per year, per occupied unit, per occupied square foot, and so on. I can also base them on potential rents or effective gross income. Each can have its own separate annual inflation. And here is where I match up whether the expenses are reimbursed by tenants who are indicated as triple net or double net. So if the expense is indicated as a triple net, it gets reimbursed by tenants that are double net and triple net. And any expenses that are not indicated as reimbursable obviously do not get reimbursed. Some summary relevant information as you go along to see how things are progressing. On my exit, I can say, yeah, I'm going to sell all my units together. Occasionally you have, say, a lot where you're selling off commercial buildings one by one or over time or something. I'm just going to say, no, we're going to sell them all at the same time. It's going to be December 2032. Here I can say my method, well, it's going to be cap rate on NOI as opposed to inputting it just a straight dollar amount of the sale. Going to be trailing 12-month or forward 12-month. I'm going to say forward 12. I'm going to sell at a 9 cap. It tells me the NOI, the valuation, the closing costs. The closing costs are input here. I can also have a brokerage commission table that I map to based on the amount of the value and so on. Here in our financing section, we can input the acquisition loan as a percent of, say, LTV. Acquisition cost is going to lend 60% toward the acquisition cost, 60% towards the TIs and renos that were indicated are included under the heading of the acquisition loan. Here's my terms of the loan, 25-year AM, 25-year loan term, 12 months of interest only, 7% interest with a 0.5 point origination fee. And I can see my little amortization table here on the loan right next to it. There's functionality for mezz debt, for grants, and I can tell the model how my equity need in the model, because the model is going to calculate the amount of equity you need based on all other inputs. So it determines how much equity you need, but then you can tell the model how to break down how much of that comes from the LP versus how much comes from the GP. And I can say, well, the GP is putting in 200 grand or whatever it is. I'm going to say, no, the LP is going to put in 90%. And just do it that way. And it shows me right there. There's a variety of GP fees that can be charged, say an acquisition fee, a capital placement fee, management fee, disposition fee, and so on. There's different ways of looking at uses and sources, for example, at the closing table versus through the end of your renovation and so on. My refinance loan functionality is quite good. You can indicate when the refi is going to happen, say what are my fees, my interest rate at that time, the cap rate at that time, so we have to value the property at the time of the refi. So maybe we say here it's a 9 cap just like the exit. And then the model is going to tell us, well, if you have 6 months interest only, a 10-year term, 25-year AM, to pay off the acquisition loan that's outstanding at that time in December of 28, there's $13 million outstanding, so you need a 43% LTV to pay off the loan. And so if I just come in and say, well, let's do a 60% LTV, that gives us a loan amount of almost 18.5 and puts $5 million in our pocket after paying off the first loan, and our DSCR is still healthy. And the last part of the model is just telling it, how are we going to distribute profits between the LP and the GP? So I'm going to say, well, the LP gets a 6% interest rate style preferred return. The return of capital is going to be pari passu in proportion to who put in what. I could also do, say, LP only or LP first. You can have a waterfall here. Let's say the first hurdle up to an 8% IRR. The LP gets pari passu 90-10. And then between 8 and a 12, it goes to an 80-20 split. Between a 12 and a 15, it goes to a 70-30. I can also do a waterfall talking in terms of GP promote instead of straight splits. And the last part of that is we have functionality for individual LPs and individual GPs, where you can say, okay, well, certain investors put in certain amounts of money. And there's also functionality for non-cash contributions. So I could say one partner gets 25 grand worth of non-cash contribution recognized, potentially for co-signing on a loan or something, right? So we're going to say, yeah, let's treat that like he put in 25 grand in cash. He's going to receive return to capital on that. We're going to say it happened in June of 25. However, he's not going to get any of the GP fees. The other GP equity would get that. And once you've come that far, that's the end of the inputs. And so at that point, you come back to your table of contents on the output reports and start evaluating your project. Thanks for watching.